Welcome back to Chapter 2. In our last session, we had an initial introduction to financial statements. Now we're going to expand on that foundation and explore some crucial concepts that will truly enhance your understanding of how companies communicate their financial health. This chapter is designed to be your guide, helping you grasp how companies prepare and present their financial information. More importantly, it will show you how you can use that information to make informed decisions. Let's get ready to dive in. Let's begin with our first major learning objective, which centers on understanding the classified balance sheet. You'll learn that this isn't just a random list of numbers. It's a very specific snapshot of a company's financial position at a single point in time. Its whole purpose is to make it easier for users to understand a company's financial health by grouping similar assets and liabilities together based on their economic characteristics. On the asset side, you'll encounter several important classifications. First are current assets. These are assets a company expects to convert to cash or use up within 1 year, or within its operating cycle, whichever is longer. Think of cash itself, short term investments, money owed to the company from customers, known as receivables, inventories, and prepaid expenses. These are typically listed in order of how quickly they can be turned into cash. Next, we have long-term investments. As the name suggests, these assets can be turned into cash, but that conversion isn't expected within 1 year. This might include investments in other companies' stocks or bonds that are held for more than a year, or even things like land or buildings not currently used in the main business operations. Then there's property, plant, and equipment, often abbreviated as PP&E. These are assets with relatively long useful lives that are actively used in a company's operations, such as land, buildings, equipment, and vehicles. On the balance sheet, PP&E is reported at its cost less any accumulated depreciation, which accounts for the wear and tear over time. Finally, on the asset side, we have intangible assets. These are assets that don't have a physical form, but still provide a company with exclusive rights for a specific period. Examples include goodwill, patents, copyrights, and trademarks. Moving over to the liabilities and stockholders' equity section, we first look at current liabilities. These are obligations a company expects to pay within the next year or its operating cycle. Common examples include accounts payable, meaning money owed to suppliers, short-term notes payable, salaries owed to employees, and even current portions of long-term debts. Following these are long-term liabilities, which are obligations a company expects to pay after 1 year. These often include long-term notes payable, bonds payable, or mortgages. And finally, we arrive at stockholders' equity. This vital section has two primary parts: common stock, which represents the investments made by the company's owners or stockholders, and retained earnings, which is the cumulative income that the business has kept and reinvested rather than distributing it as dividends. Understanding these categories is fundamental to interpreting a balance sheet effectively. Now that we've grasped the structure of the balance sheet, let's explore how we can use that information to gain deeper insights into a company's performance. Our second learning objective for this chapter focuses on using financial ratios, which are truly powerful tools. Financial ratios express the mathematical relationship between different items of financial statement data. You can use them for various types of comparisons, looking at the same company over different years, comparing a company to the industry average, or even comparing it directly to a competitor. We'll look at three key types of ratios. First, profitability ratios. These reveal how successful a company is at generating a profit. A crucial example here is earnings per share, or EPS. This ratio measures the net income earned on each share of common stock, giving you a clear picture of the earnings available to common stockholders. It's incredibly useful for investors to gauge their return and for tracking a company's earnings performance over time. Next, we have liquidity ratios. These indicate a company's ability to pay its short-term obligations, those expected to become due within the next year or operating cycle. They're based on the relationship between current assets and current liabilities. One measure is working capital, which is simply current assets minus current liabilities. When working capital is positive, it suggests the company is more likely to pay its debts. Conversely, negative working capital can signal potential issues. Another key measure is the current ratio, calculated by dividing current assets by current liabilities. It offers a more dependable indicator of a company's short-term ability to meet its obligations and unexpected cash needs. Finally, we come to solvency ratios. These measures assess a company's ability to survive over the long term. They indicate whether a company can pay interest as it becomes due and repay debt balances at maturity. A prime example is the debt to assets ratio, which is total liabilities divided by total assets. This ratio tells you the percentage of a company's total financing that comes from creditors rather than stockholders. Generally, higher ratios imply a greater risk that the company might struggle to pay its debts as they come due, though what's considered high can vary significantly across different industries. Understanding these ratios empowers you to analyze a company's financial health far beyond just looking at the raw numbers. Beyond understanding the numbers and ratios, it's vital to grasp the foundational principles and assumptions that guide all financial reporting. This is where we learn about the rules of the game. In the US, financial reporting is guided by generally accepted accounting principles, or GAAP. These principles dictate how information is disclosed and measured. Key organizations like the Financial Accounting Standards Board, or FASB, set these standards, ensuring consistency and transparency, alongside international bodies like the IASB, which develops IFRS. For information to be truly useful, it needs two qualities: relevance and faithful representation. Relevant information makes a difference in decisions, helping predict the future. Faithful representation means it accurately depicts what happened. It's complete, neutral, and free from significant error. Qualities like comparability and understandability further enhance its usefulness. Underpinning all of this are fundamental assumptions. For example, the monetary unit assumption means we only record things expressed in money. The economic entity assumption keeps business transactions separate from personal ones. The going concern assumption assumes a business will continue operating. Principles like the historical cost principle mean assets are typically recorded at their acquisition cost. The full disclosure principle then requires companies to disclose all important circumstances and events to users. Finally, there's always a cost constraint, balancing the cost of providing information against the benefit users gain. And that brings us to the end of our overview for Chapter 2. We've covered a lot of ground, from the structure of a classified balance sheet and what each section represents, to using powerful financial ratios for analysis, and finally, understanding the foundational principles that govern how financial information is reported. This knowledge isn't just theoretical, it's immensely valuable for truly understanding a company's financial health, making informed decisions, and building a strong foundation in your accounting journey. Keep exploring, and I look forward to our next chapter together.